to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to another episode of On My Way to Wealth. My name is Luis Rosa, and I'm your host. I hope you are happy, healthy, and safe. It is very common nowadays for us to switch jobs often. And when that happens, sometimes we tend to leave 401ks behind with the old employer. Or in the case of our current situation, some of you might have lost your job and you now have to make a decision as to what to do with your old 401k or employer retirement plan. Let's talk about what our options are. In general, you have 4 options. Option 1, leave it where it is. It is possible that the current administrator allows you to keep it where it is. This is the path of least resistance because you literally have to do nothing. However, this may not necessarily be your best option depending on your situation. For starters, if you plan on continuing to work, you could no longer contribute to that 401k because contributions can only come from your paycheck, which you're no longer receiving. So the 401k plan just sits there with the funds that you currently have in them. As you know, you're also very limited as to what you can invest in, since the plan typically has a limited menu of options. As you switch jobs, you can also end up with several 401ks out of there. This is not ideal because it is harder to manage. Keeping track of all of the different funds, the statements from the plan, it makes for poor planning. Option 2, if you have a new employer, it is very likely that you can do a transfer into your new employer's 401k plan. This is a common practice. This helps you consolidate your 401ks, have all of your 401k money in one place, and continue to contribute. This makes it easier to keep track and to also manage your accounts since they're all in one place. Your third option is to open up your own rollover IRA at the institution of your choice and then roll the funds directly from the 401k into your IRA. Ideally, you like to do a direct transfer so that the money does not pass your hands, and this way there's no tax withholding and it does not trigger a taxable event. The IRS allows a one-time distribution every 12-month period from a retirement account and gives you a 60-day window to roll that money over. However, you can do unlimited direct transfers from one account to another. So this is your best option. If you do it indirectly, your old 401k may withhold a mandatory 20% for taxes, which means you have to roll over the full 100% to avoid taxes. Let me give you an example. Say you had $15,000 and you take it out directly. The old 401k will withhold $3,000 for taxes and then send you $12,000. However, if you only roll over the $12,000 you received, you will have to pay taxes and a 10% penalty if you're under the age of 15 and a half on the $3,000 that you did not roll over because it was withheld for taxes and sent directly to the IRS. So the other option is to roll over the entire $15,000. However, in order to do this, you will have to come up with the $3,000 out of your own money. The money's not lost because you'll have a $3,000 credit for your withholding for taxes. So if you were going to get a refund, you get an extra $3,000 at tax time because you already came out of pocket with the money. All this can be avoided by having one company do a direct transfer to another. You can also roll it over into a Roth IRA, but you would have to pay taxes on that conversion. It's called a Roth Conversion. This can be a good idea if you're going to be in a lower tax bracket this year, but be sure to consult with a financial planner or tax professional to see if this is a good option for you. I also talk about this on episode 25 of the podcast, so be sure to tune in. Then there's option 4. You can take the money out. When you take the money out of a 401k, you will have to pay income taxes on the distribution because the contributions were put in pre-tax. If you're under the age of 59 and a half, you'll pay an additional 10% penalty. There are some exceptions, like if you're disabled and now during COVID-19, there are also some other special guidelines as well, which provide more flexibility. I talk about these in episode 24, so be sure to tune in. If for some reason you see yourself in a situation where you've already had to take money out or are going to have to take money out, there are some COVID-19 eligible distributions, which I go very in detail on that episode. So be sure to tune in. Let me give you an example of what happens when you take money out. Say you took $15,000 and you don't qualify for any exceptions. You'll get a 1099-R at tax time, and then you have to pay income taxes on that money, which also gets combined with your other income. And this may or may not put you in a higher tax bracket. So be sure to speak to a financial planner or your tax advisor before you do that so that you can make an informed decision and make sure that you're doing what's right for you, because you can end up paying more taxes than you need to. So those are the four options. Leave it, roll it over to your new employer, roll it over to an IRA, or do a Roth conversion, or take the money out, right? So two more things to consider before you decide what to do. If you have noticed there is something called a vested balance in your statement, what that means is that the employer's contributions, if they were matching, they have a vesting schedule that decides when that money that they contributed for you is yours to keep. Typically, it's a certain amount of time. So, for example, a lot of employers might say, if you're here for a full year, you can leave and take the contributions that we put in for you. Some of them do it, say, like on a 20% increment. So year one, you get 20%, year two, 40%, year three, 60%, and so on until you're there for 5 years and get the full 100%. So make sure that you also understand that, because you might think you have more than you do because the vested balance might be lower than the actual balance, depending on how long you've been there. So take that into consideration. Also, the other thing to consider is, what if you had a 401k loan outstanding? Now, that might be a problem because you have to start making payments now out of pocket for that loan. And if you don't pay the loan back, then the outstanding loan balance becomes taxable income, and also subject to the additional 10% penalty if you're under the age of 59 and a half. So talk to the plan administrator to see if you can keep the plan where it is, continue to make payments, and then once the loan is paid off, you can decide to move the assets if that's the option you're going with, unless you're going to be in a lower tax bracket than usual and it makes sense for you to just take the hit for the taxes and the 10% penalty. So that is pretty much in a nutshell. This was a very quick episode. Just wanted to give you the options because I know a lot of you are in that situation where you might have to start taking money out of a 401k, or you might have gotten laid off as a result of COVID-19. And hopefully you're in a situation where you don't need to touch the money. But if you do, now you know your options. So that is our show. I thank you very much for listening. If you have any questions, comments, or suggestions for a future show, please reach out to me at luis@onmywaytowealth.com. Stay happy, healthy, and safe, and I'll see you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.